Hi, everyone, and welcome to the webinar. Per your request, we're actually going to be talking about business acquisition checklist. When I did the last webinar, you have actually asked me for this particular topic. So I did put together some information on some things to look for when you acquire a business. Now, keep in mind that some of these things should be part of your due diligence process when you're actually purchasing the business, but I think that there are some things that could be expanded upon once you actually purchase the business. As always, we are recording this webinar. This webinar will be available online within the next 2 days. As always, we want your participation, so throughout the program, feel free to ask questions, raise your hand so that I know that you have a question, and we'll go ahead and answer it. If it's pertaining to what we're talking about in the topic, or if you have something else that is important for you to get answered for you to be successful in your business, please feel free to ask. And then again, as always, I want you to make sure to let Patrick know when there's a specific topic that you would like to see covered in the webinar. So let's go ahead and get started. There are a couple of things I'd like to go over. Just kind of as a reminder, I know some of you are new to this, and I wanted to go about and tell you what Mike looks for in terms of companies. What are the criteria for him to actually consider working on a particular company? So what he's looking for is he is looking for a business that has been in operations for two to 3 years or more. So he's not looking for any startups. He's looking for businesses that are established. He's looking for businesses that have gross revenues of $1 million or more. So that's really important. He's looking for businesses that are in one of the following industries: manufacturing, distribution, retail. Although when he talks about retail, he's looking for online retail. He's not looking for brick and mortar retail, so he's not looking for an actual store. Retail store, he's looking more for an online retail operation. It could be technology, and it could also be something in the service industry. Now, businesses can be outside the United States, but if you're looking at a business that's actually located outside of the United States, you want to make sure that English is the primary language that's being used in the business. Also, businesses can be online or offline, or a combination of both. Mike avoids restaurants or franchises. He also typically avoids assisted living, although he might look at something on a case-by-case basis. So if there is something that's assisted living that just looks like a really great opportunity, he might potentially work on that, depending on what the conditions are for that particular business. Things that he's looking for in terms of optimal qualities: he's looking for businesses that are sales or marketing driven. He is looking for businesses that possess some sort of exclusivity or uniqueness in product design or service. He's also looking for products or services that have a high gross margin. Also, products and services that have built-in demand. And then a product or service that does not compete solely on price, so things that are not commoditized. So cheapest isn't always the best. So you want to make sure that you really understand the value proposition, and it's a value proposition that's easy to communicate and to understand to the prospects and customers. I always like to show this link. This is a link that is to a free business valuation tool. I have had several people that I've coached use this, and it really helped them to be able to strengthen their positioning when they were dealing with a business owner. What this tool does is it allows you to enter in information regarding the financials, and then it'll give you a value based upon those financials that you entered. I recommend that when you're looking for a business, business owners have a tendency, they don't always know what the value of their business is, and a lot of times people will put a price tag on their business that equates to what they're looking for retirement. So this link will be something that will be a good guideline for you. You can actually enter in some information and then see if that number that they've actually come up with is a number that's even worth considering, or even worth going through the process of going through due diligence and and negotiating. So this is a great way for you to enter in some basic information about the business financials, and then you'll get a good sense for, is that price that's being asked within the ballpark? I've also had people that are in this program use this valuation tool as to strengthen their position. I had one person where when they originally started talking to the business owner didn't even want to consider owner financing. Also was somebody that wanted to be completely out of the business. The person that I was working with used this tool and put in information regarding that business, and it basically said that the business was worth nothing. Well, it was interesting because that put the student here at Business Mastery University at an advantage. He basically was in a position of strength, and it was interesting because he was ready to walk away from the deal, and then this business owner was all of a sudden willing to discuss owner financing, and there were several options put on the table where the business owner would actually help to continue to build the business, and then there was a buyout in the agreement. So anyway, and it was done over time. So this is a really valuable tool, and I haven't used it in a while on these webinars, so I figured it was time for me again to go ahead and provide that to you. So like I said, the last time I did the webinar, this was something that came up in the discussion, and I want to stress, at the time that the question was asked, could I put together a checklist of things that you would be looking for when you acquire a company? And I have to say that a lot of these things that we're going to be talking about should be part of your due diligence process before you even buy the company. And again, the things that we're talking about today, you might use all of them, some of them. You might need to expand on some of these things. It's on a case-by-case basis, but what I hope to accomplish today is to cover some areas that we can discuss, some things to actually consider when you acquire a company. So the first thing I want to talk about is the business itself, kind of a business overview and things that you need to consider when you're when you're buying and also acquiring this company and doing the transition to take it over. So I know that we've talked in the past that a really important question to ask is, why are they selling? There has to be a good reason why the owners of a business want to sell it, and they may have really excellent ones, such as, they might be raising funds for an estate tax payment, maybe there's a divorce situation, maybe they want to retire, but many times there can be hidden reasons. Sometimes it's because they're expecting a lawsuit, or maybe they're noticing some downward trends in the company's prospects that are affecting revenue. So you want to make sure that you're aware of why they're selling, and you want to make sure that you uncover what the reasons are, if there's any hidden reasons, and could it present a significant problem when you actually acquire the business. So you want to find out what those are, and then basically make a decision on, is it worth it for you to take a risk? If you see potential in it, obviously you can move forward, but you want to make sure your eyes wide open in terms of what's going on as to why that business is being sold. The other thing you want to find out is, have the owners of this company attempted to sell it before? And if so, you got to find out what happened. What happened? What was the deal? Did the former prospective buyers walk away? Why did they walk away? You need to find out whatever information you can regarding any previous sales efforts of that particular organization. Another thing you want to find out is, maybe they were in negotiations with somebody, but then there was an issue with price. Maybe there was an issue with risk. Maybe the value of the company wasn't up to snuff, and that's why you having that online tool is going to be a great help for you to determine if that business's price is even in the ballpark of what its actual value is. And remember, we're trying to buy these businesses where we want to find opportunity, we want to look at it in eyes wide open. We want to make sure that we have a plan to increase the value of that company in a reasonable amount of time, so that we can go ahead and sell that business and then make the money that we're looking to make. The other thing you want to look at is business plans. So you don't only want to obtain the most recent business plan, but if there's any earlier versions of it, you want to take a look at those too. You should look at those documents and compare them to the company's actual performance and activities, and see. It's going to give you a good it's going to give you good insight to see if the management team is actually capable of implementing their own plans. So I know that there's a lot of businesses that when they launch a business, they put together a business plan and a business strategy, and then they kind of just leave it alone. And I always feel that business plans are something that are living, breathing documents that should be constantly updated, evaluated. You want to make sure that you're hitting the you set out for yourself. So it's really important to find those business plans, get the most current one, and see if you can find any previous ones as well. The other thing you want to look at is the complexity of the business. How complex is that business? If it involves a large number of subsidiaries that deal with a lot of products and services, it might be too difficult for you to manage the operations. You want to make sure that when you're looking at these businesses as part of your due diligence, you want to have a good sense for what are you willing to take on, what's the size that you can manage based on your expertise and how much you want to be involved in the business. What are the risks that you're willing to take on? How complex can you handle a business? So you want to definitely get a good understanding. Even before you start looking at companies, I think you should take a look in the mirror and ask yourself some questions in terms of, okay, when I have this business, do I want to be hands-on? Do I want to bring in a team to actually run that business? What's my plan going to be in terms of how I'm going to put together a strategy and then implement that strategy to get to where I want to go to increase the value of this business? So there are types of businesses, these businesses that have a lot of different subsidiaries, disparate subsidiaries, they're typically very difficult to grow. And on the other side, a company with a simple product line or service is really an excellent opportunity for someone to actually buy and then grow. So that's something that you want to look at when you're doing your due diligence, and then looking to see, validate what you uncovered during the due diligence, and then, expand on that when you actually buy the company. The other thing that you want to do is you want to do a market review. So you want to review the primary players in the marketplace and in which the target competes, and in which target you compete. So you want to make sure you understand your competition. You want to find out who's there, how are they interacting with customers. You want to determine the competitive niches occupied by each one, and you also want to understand how their actions may impact you and your business. You also want to monitor trends in the industry to see if there has been any changes, or if there's any expectations to changes in profit levels or even the size of the market. You also want to go ahead and examine the expected impact of any type of new technology on the market and how the company is positioned in relationship to those technologies. I've been told from people that I work with that in terms of the industrial industry, that manufacturers, if they don't do something disruptive here, if they don't do something real disruptive to give them a competitive advantage, we're going to have a lot of manufacturers that go out of business because many of them are still doing things the same way they've been doing them 20 years ago. So those people that come up with innovative ways to disrupt their industry are the ones that are going to actually survive in the future. The other thing you want to look at with these companies is an ease of entry. Is this an industry in which competitors can enter and exit very easily? Or are there very significant barriers to entry? Has there been a history of new competitors arriving and then taking significant market share? Or does market share appear to be locked in among the current players? That's something that's really important for you to understand so that you could figure out what your plan is going to be to maximize your opportunities. You also want to look at any related acquisitions. Has there been any other acquisitions in the industry lately? Have other businesses put themselves up for sale in this industry? What's driving the trends? Is it possible that the industry is going through a period of consolidation which could impact the price that you offer to offer to people that are going to potentially buy your business? That's something that you need to look at. Another thing that's extremely important is for you to get an org chart. You want to make sure that you understand what the various relationships are. Who are the key players? What are the functional areas? Who's in charge of those? So you want to obtain a chart that states the reporting relationships within the business. This is going to be really useful for determining which managers are in charge of which sections of the business, so that the team knows who to contact for more information. It also tells the team who to investigate for roles in the business, when you actually take it over. So that's something that's really important for you to know. You also want to have a good sense of the geographical structure. If the business is based on sales, regions, you want to examine how the organization is structured to support regional sales. It was interesting because I actually met with somebody today that was explaining to me the challenges of managing a sales team nationwide. He was talking about it was difficult to motivate, difficult to communicate. You get, believe it or not, even though it's the United States, we have different parts of the country that have very different cultures. So having to adjust and deal with those people in different parts of the country requires sometimes an adjustment of, how to talk, how to communicate, etc. So that is something to consider as well. And you also want to make sure, is there adequate infrastructure at the regional level for the activities such as sales, marketing, distribution, and storefronts, if there are any. So you also want to find out if there's any weaknesses, and then possibly those weaknesses could be an opportunity for you then to improve profits. So again, eyes wide open, looking for those opportunities that have been missed by the the past owners, and for you now to take the opportunity and make the money. You also want to get an organizational legal structure chart. So a chart that states, are there any subsidiary entities? Who are they owned by? Are they owned in part or in whole by the parent company? Where are they all incorporated? What's the ownership structure of each one? This is going to become a really important document. For the team needs to know if there are any hidden majority or minority investors buried in the organizational structure of the company. And I know that I mentioned this on the last webinar. I was actually working I was going to purchase a very niche tool and die company, and they happened to own the building that they were having the business operate in, and they also owned the land. And it was really interesting because everything was going along really well. And then we found out that the building and the land was in a trust for various members of the family, and they had a say in what was going to happen with the business. And that was something that came out very late in the process, and it derailed our attempt to actually purchase that company. So you want to be eyes wide open and understand who's involved, what is the structure in terms of ownership, who owns stock, who has a say, who gets to have input on anything going on with that company during the process. Okay. The next thing you want to take a look at is the employees. So you want to get information on the types of employees. So you want to obtain information about the number of employees in the various functional areas of the company, such as production, materials management, accounting, treasury. So you want to have a really good sense of how the employees are organized and what their functional areas are. You also want to get a good understanding of who the key employees are. And do you need them? I mean, in some cases, when somebody sells their company, it turns out that the owner was a critical piece of that business, and now that he's gone, that could impact the growth of that business. So you want to make sure you have a good understanding of the key employees and what their roles are, and figuring out what would happen if they would be gone. Do you need to take into consideration to involved in the business during a transition process so that you can continue to operate to sustain yourself and then to figure out a growth strategy? So you want to make sure that you have a really good understanding of key employees. You also want to know about customer linkages. Do any employees have such close contacts with customers that they could actually take customers with them if they were to leave the company and go into business elsewhere. This is a bigger problem in specialized service industries such as investment management, consulting, and accounting services. So that's something that you really want to key in on and make sure that your customers are going to stay with you, because of the company and its brand and customer service, not because of individuals within that organization. The other thing you want to be very clear on is what is the total compensation that is being received by the employees. So you need to compile the total cost of the top employees. So this means not only their base pay, you have to think about and find out about the commissions, the bonuses, any stock options, payroll taxes, but you also want to find out about any benefits and any reimbursements for a variety of personal expenses. So you want to make sure you have a good handle on that. You also want to have an understanding of the pay level philosophy. So what is the company's philosophy for the level of compensation it pays to employees? Is it near the median pay rate for most positions, or is it substantially higher or lower? I had another conversation this week regarding technology professionals. Right now, I know that there's a shortage of, there's a lot of jobs open with very few people able to fill them. So basically, those that have technology expertise can pretty much call the shots in terms of what they're going to get for benefits, money, etc. In fact, I know that I have a personal customer of mine that is an IT managed services company, had had technicians that were with him for the past 8 years. All of a sudden, they up and left, 2 of them at the same time, and he has been struggling. He's been struggling for the last 5 months to find people to replace them, and it's because there's a shortage. There's student visas are not being treated the way they have been in the past. So we had a lot of foreigners that were technicians, and they're not available. So when there are technical jobs available and there's someone with that particular technical expertise, they pretty much get to call the shots. So there's a real shortage for technical personnel. So just something to keep in mind. Also, you want to have a good sense of pay history. You want to construct a chart detailing the last when each person was given a pay increase and also the amount of that increase. You also want to find out, were there any pay freezes? Were there any financial difficulties recently? Did they impose a pay freeze on its employees with the promise of immediate increases as soon as the financial situation improves? Obviously, that would impact you. This creates an expectation that because you're now the new owner, increase pay. So that's something you definitely want to be aware of. Agreements. There may be agreements with some employees entitled to a certain amount of severance pay if the company elects to terminate their employment. You should basically locate all these agreements and document the amount of severance payments. In the case that you decide to eliminate their positions or replace them, you need to be aware of that so you know what your liabilities are going to be. You also want to get a sense for, is this company a union company? Are there some groups of employees within the company that are represented by unions? If so, you need to obtain a copy of the union contract and then peruse it for scheduled, wage rate changes. You also want to find out, are there any work rule limitations, any guaranteed benefits, and other issues that could alter the costs, associated with the business. In particular, you want to look for restrictions on the ability of the company to outsource work or to relocate facilities, because a lot of times the unions put in very specific things in their agreements with regards to that. You also want to be aware of any discrimination claims. Are there any pending discrimination claims against the company? Has there been a history of such claims in the past? If so, are the claims related to a specific person, or are they spread across the management team? So that's really important for you to know. Injury records. If the company is involved in manufacturing or distribution, review the employee injury records. Does the business suffer from an inordinately high proportion of injuries, or do workers' compensation claims appear to be excessive? If so, you might want to consider bringing in a safety expert to review the company's facilities and then to estimate the cost of adding any needed safety equipment, personnel, procedures, or training if you need it. So that's something else to consider. And then you want to make sure that you see the employee manual. Always obtain a copy of this employee manual. It should contain policies that impact the costs associated with employees, such as vacation, sick time. Do they have vacation carry forward? Do they have annual reviews? What about jury duty, military pay, bereavement pay, severance pay, and so forth? So these are all really important for you to understand. Any questions so far? I know we're a super small group today. So Jim, do you have any questions about anything that we've covered so far? If you do, just raise your hand and then I'll unmute you. I know that when I was asked to put together kind of a checklist, I'm a little hesitant because sometimes when we do checklists, it's a lot of material. I'm always trying to figure out what's the best way to present these things that it's not going to bore you to death. So I know that we've been going over a lot of things really quickly. It's kind of difficult when we have a checklist. That's why I like to usually take it in sections and discuss why they're important. But since this was the request, I figured this was the easiest way to actually cover this. Okay, Jim, let me go ahead and unmute you. Oh, I think you are self-muted. So you need to unmute yourself first, and then I'll go ahead and open you up. No, let's see. Did you type the question? Let's see here. Oh, there you go. Okay, so you're good so far. Okay.
I said that was good so far.
Okay, very good, very good. All right, well, feel free to chime in at any time, even if you have a specific question about something that you've been experiencing. All right, so the next thing I'm going to go over that you need to consider is employee benefits. So you need to be aware of what medical insurance is offered to employees. What is the portion that has to be paid by employees? What's the portion that the employer pays? Is any insurance also offered to retirees? How do these benefits compare to what is offered to employees elsewhere, right, in these businesses? Is the standard amount of benefits offered in the target in this company's industry different from what is offered in other industries in which you're competing? So that's something else that's really important for you to understand. Pension plan funding. Is there a defined benefit pension plan? You're going to need to ascertain whether the plan is underfunded, and if so, by how much. Also, you need to review the funding assumptions used to derive the level of funding. It may contain really optimistic assumptions concerning the future return on investments. So you need to be very aware of what the funding is, why is it the way it is, and does it make sense going forward now that you've acquired this business. Vacations. You need to figure out, sometimes it's really critical for certain people to be around during certain times. What's the vacation policy? Determine the amount of vacation time to which each employee is entitled, and then how that compares to the industry average and the company's stated vacation policy. So it's something that you want to understand. Financial results. This is something that, again, as part of the due diligence before purchasing the business, you should have a good handle on the financials. So you want to look at, there should be financial statements for the past 5 years, which the team should translate into a trend line comparison for the full 5 years. You want to really understand those numbers. Those are going to be able to show you where your opportunities are. That's going to show you where the trouble areas are. You want to make sure that you have a good understanding. You also want to understand cash flow, so you're going to have to do a cash flow analysis. A key part of the financial statements is the statement of cash flows. So this document is going to reveal the sources and uses of cash. You want to be very mindful of the information in this report when you're reviewing the income statement. For depending upon how the company reported, substantial profits, you want to understand what are they using cash for? Are they burning through the cash? You want to make sure there's enough cash to actually run that business. And is there anything that you can do to improve cash flow? You also want to understand cash restrictions. Is cash restricted from use in any way? For example, the local bank may have issued a performance bond on behalf of the company, and it has restricted a corresponding amount of the company's cash. Another example could be a cash restriction in order to fund a letter of credit. So you want to be very well aware of those. Expenses categorized as non-operational. A company could shift expenses into a non-operational expense category, such as financing expenses, in order to make the earnings from operations look more impressive. So, when I've talked about understanding the financials, you can make the books look anyway. That's why it's really important to also look at the taxes to make sure that the taxes match what the financial statements are saying as well. You also want to look for one-time events. You want to see if there were any operational events that are unlikely to occur again, and then strip them out of the results of operations. This is a common problem. Like when you're actually buying a business, if you don't take care of that, that could actually skew your numbers and not give you a true picture of what it is that you need to be looking at. You also want disclosures. You want the audited financial statement should include a set of disclosures on various topics. So the team should review these disclosures in detail, since a lot of times they reveal a great deal more information about a company than is shown in its actual income statement and balance sheet. So I always say that it's best to have audited financials, because that means that an accountant, a CBA, has actually looked at those numbers and has validated them, and these disclosures then would provide explanations various GL accounts and the reports themselves. Public filings. If a company is publicly held, it must file the Form 10K annual report. Form 10Q is the quarterly report, and a variety of others issues on the Form 8K. So all of these reports, I doubt that there would be many publicly held companies you go after, but you do want to make sure that all the paperwork is compliant, if it is a publicly held business. You also want to keep track of management letters. After an audit has been completed, the auditors sometimes compile a set of recommendations into a management letter, which they then distribute to the CEO and audit committee. So any such letters that were issued in the past few years are definitely worth reading, because they typically contain suggestions that are going to help to rectify deficiencies found in the company's practices. So you might have in these management letters ideas that were submitted to the owner or the CEO of the company that you might be able to actually implement to help you then to grow this business. All right, revenue. So in the revenue category, you want to ascertain the total amount of backlog. So by month for at least the past year, this may reveal an increasing or decreasing backlog trend, which is a strong indicator of near-term revenue levels. So that's something you want to look for. You also want to look for recurring revenue streams. That's a key value driver in a business, is its recurring revenue stream. That means that this is recurring sales. This is people who are doing repeat orders. So determine the amount of baseline revenue that then can be expected to arise on an ongoing basis. Okay, that's really important. You also want to look at any customer changes. So you want to take a look in the past 3 years. What changes have there been among the company's top 10 customers for each product line? So what you're trying to determine with this analysis is to see, is there a net decline or increase in larger customers, which is an indicator of the general trend of the sales. So that's something you want to make sure that, obviously you want to retain customers. You want to make sure they continue to buy from you. So you need to understand their behavior. What they buy, could you sell them more? Are they aware of additional products and services? So these are all things that are really important for you to understand. You also want to understand available regions and channels. So are there any likely geographical regions or distribution channels that the company has not yet entered? Maybe perhaps this particular owner wasn't comfortable going out of a certain state or city or region. Maybe there's some potential there. Maybe there's some opportunity that for you to actually do that to grow the business. So an attempt to quantify the sales and margins are likely to result from entry into different channels and margins. You also want to get a good understanding of the pricing philosophy of the company. How did the company set their prices? Does it add a percentage profit to its cost, or does it charge based on the value of the underlying product, or does it set its prices based on those of competing products? So does it position its prices somewhat low to follow a value strategy, or somewhat high to follow a premium pricing strategy? So you need to take a look at that and figure out. And the other thing you need to look at, are things priced in a way that you're actually going to have profit? Because I got to tell you, I've worked with a lot of people who they just put pricing on things without really understanding what the cost is to provide that product or service. And I had a customer that was really proud of this one customer that brought in several million in revenue, and guess what? They never made a penny on any of it. So you want to make sure that you understand the pricing model, and is that pricing model a good one to use, and is there some potential opportunity there to find a way for you to either lower cost of providing that product and service, or to actually do something with some discounts to get cash flow moving more quickly. I've seen situations where a lot of companies were invoicing net 90 because that's the way they've always done it. Well, think about if you changed it from net 90 to net 30. Right there, there's going to be an improvement in cash flow. So estimating is another thing you want to look at. Does the company have an estimating department that derives prices for customized service or products? If they do, examine the model for soundness, and then investigate whether the company has persistently lost money on incorrect estimates in the past. It's kind of interesting. I was talking to somebody that has a client, and because there's those new tariffs on China, there's people that actually have put together proposals and bids based on information from 6 months ago. So now with these tariffs from China, this is somebody who was getting alumina from China, and he has now put together these proposals that have been accepted. Well, now because the price has gone up, they're not going to make the revenue or the margins that they had anticipated, and that's something that they really didn't anticipate for. So those are all things to look at when you're looking at what you could do with that business. Contract terminations. If revenues are derived from customer contacts, you want to make sure that you get copies of those contracts and then determine the remaining stream of payments that's going to be related to them. You also want to know when they expire, and you also want to understand the likelihood of obtaining extension on those contracts, or would they be renewed. So that's something that's going to be really important for you to understand to get a good sense of current revenue as well as future revenue. You want to understand the accounts receivable. You want to review the most recent accounts receivable aging report to see if there are any customer invoices that are overdue by unusually long periods of time, and then find out why. Why are they not being paid? You want to understand that. So this is another opportunity that if it could be that the previous owner lost track, or just didn't have the time, or didn't feel the needs, or sometimes things just get missed. So this is something really important for you to check into. Make sure that all the I's are dotted and the T's are crossed, and that all the numbers add up. Any questions on this section? Anything at all here? Just raise your hand if you have any questions. Okay. Okay, cost structure. So in terms of cost structure, you want to take a look at expense trends. You want to load the company's income statements for the past 5 years into a spreadsheet, and then create some trend lines from this information as a percentage of sales to see how expenses are trending. So if you're manufacturing a particular product, you want to find, just like I just told that story about the aluminum, is that a moving target? Is that something that you're going to have to basically reevaluate on a month-to-month basis? Is it something that, depending upon the market, price, is it something that fluctuates on a very regular basis? Is that something that has to be analyzed like constantly? You also want to take a look at questionable expenses. You want to review certain expense accounts for questionable expenditures. So these typically relate to items such as personal expenses that are charged to the company, and trust me, a lot of business owners do this, reimbursing employees for medical deductions or excessive travel costs. There might be some opportunities there for you to lower costs and then, increase profitability within that company. You also want to see, does the business do any loans to employees? So if there are any loans, you want to determine the amounts of those loans that have been extended to employees. You also want to see if it's acceptable. If, is it acceptable that these are small payroll advances for a short period of time? But, sometimes there's long-term loans under which there's little or no repayment that's been made. You need to treat those as expenses that then reduce the profits of the company. So you want to look out for those and figure out a way to reconcile those. Fixed assets, a key part of the cost structure of the business is its fixed assets. So if there have been few fixed asset replacements in recent years, so we're talking about equipment, we're talking about, tools, we're talking about, is the facility crumbling, right? If there's been few fixed, asset replacements in recent years, it could indicate a lack of attention to the future competitiveness of the business. If a reduced level of investment is evident, then you should then reduce the valuation of the company. So this is something as part of your due diligence you need to look at. So if it looks like they haven't taken care of things or they haven't updated or upgraded, that gives you something to negotiate when you're talking price. So that is an opportunity for you to then, once you start working with the company, then you can make those improvements, and that's potentially an opportunity for you to provide better service. You might be able to fulfill quicker. So those are things for you to look at as well. Okay. I don't know if we're going to finish this today because there's a lot of stuff here. So if we don't finish today, I'll actually continue this topic on the next webinar that I do. I'm not going to be doing the webinar next week, but I'll be doing it in 2 weeks. So then what I'll do is I'll actually continue the conversation. Let me ask you something. Me to continue now, or do you have questions about what we've talked about? Do you have any questions about what you're working on so far? I'm going to go ahead and unmute you. Oh, you're self-muted. So unmute yourself so I can see if you have any comments. Okay, there you go.
Okay, I'm here.
Okay. Is there anything, we've covered a lot of material here. Is there anything that you're working on or anything that you're experiencing that, you'd like to discuss or talk? Do you have any questions about, what you're doing with this business flipping program?
Well, I probably do have a lot of questions. I just, probably for me is like a more of a involved in my day-to-day activities in my other businesses. So
okay, what are your other businesses?
Real estate, and the other one is bail bonds. Of course, my wife kind of runs that company mostly.
Okay. Okay.
And I've been buying houses at the sheriff's sale.
Oh, okay. Okay. Has it been working well for you?
Well, yeah, I've bought 4 houses in the last 3 months.
Okay.
And probably I actually just bought one this morning.
Oh, wow. So what are you doing then with these? Are you actually fixing them up and then flipping them?
Yeah, and I guess the reason that I'm so motivated to do that right now is, I guess in my mind, I feel like I need to have seed money to stick into another business.
Okay.
And I guess that's my motivation on it. It isn't that that combined with the market is so ripe for it, I guess.
Uh-huh.
Because
what part of the country are you in?
I'm in Wisconsin.
Oh, so. That's not far from me. Where in Wisconsin?
Appleton.
Yeah, I know it. Okay. Okay. I'm in Chicago, but I spend a lot of time in Wisconsin. I have a horse in Wisconsin.
Obviously, you know where Milwaukee is in too. So, Just west of Milwaukee is Waukesha, and that's where I was
Right.
this morning. That's where I
Okay.
run the.
Okay. Okay. I was unaware that you could pick up houses for a really good price, and then I didn't even think about that with the sheriff's sale. So now, why did you get into this?
Well, my 5-year goal is basically to take the real estate equity and assets that I've had and continue to get because I'm good at finding deals like
Okay.
that, and just leverage that or liquidate them as I go, whatever, and get into other businesses that are cash flowing. That's my 5-year plan. So.
I see. Now, is there a particular business that draws you to them? Like, is there a certain industry, certain type of business that you like or are passionate about?
Well, I guess I'm still determining that, I guess. I'm looking at businesses. I pretty much slate, usually it's Mondays that I slate to actually actively looking for new business leads. And I have several businesses that I'm evaluating right now. One of them is actually from the Deal Vault. And so I'm actually looking at that one right now. I probably could use some help on figuring out what to do with it, to be honest with you.
Okay.
It's a much bigger business than I'm used to looking at, and I learned at a real estate course a long time ago for luxury houses that really just upgrading from a regular $100,000 or $200,000 single family property to a million or a $2 million property is just another zero.
Mm-hmm. That's funny. So, well, I guess, one of the things is, you're the only one on this call today. And, when you buy into this program, you get coaching calls with me. And it's like, that's why I always, I'm trying to encourage people to get information on these calls because it doesn't tap into your coaching call, right? So that's why I figured I'd give you the opportunity here to ask some specific questions about some things that you're doing.
Well, let me ask you this. I have several businesses that I've been looking at, and I'll keep it focused on business instead of real estate. But although real estate business can be a business in itself, but
sure,
I just didn't want to take up the time on this call to do that. But so I have it's a smaller company, and the reason I'm bringing it up, the seller keeps calling me. I think he's motivated. He wants to sell it. And I'm trying to figure out what to do with it, if I should do anything with it at all. But he was originally asking $750,000 for it. It's a HVAC company, and I do have a mechanical background, I have a mechanical aptitude. So although I definitely don't want to be running it, it's located in Colorado. Okay.
Okay.
It makes it impossible for me to run it, which I think is great. Because,
okay.
As we're on the call right now, I was in the middle of doing copper piping in one of my houses, so I have a tendency to get too involved. Okay.
Okay.
That's one of my weaknesses because I know how to do so many things. I'm like, oh, I can do that quick. I don't need to call anyone. So, but long story short, on this business, this guy is he's going through some kidney dialysis. That's really his. Yeah. And interestingly enough, I looked at the company a little over a year and a half ago, January of last year.
Okay.
And I didn't know what to do with it then, and I just I think I keep getting stuck. He's got several employees. Okay. His wife answers the calls though, and so does he. And it's a smaller company. I say that the gross net, the net profit is probably around $200,000 to $250,000.
Okay.
And I don't have the figures in front of me. I'd have to go back and look at it. But since he started dialysis, well, let me just back up a second. I looked at the company with my wife. We flew out to Colorado. We looked at it. Why did we fly out to Colorado to look at that? Well, we had another reason to do that also. So we didn't just go out there to look at this company. But
I figured that.
But it was really neat because he put us up in a condo, and
Oh, nice.
it was his condo, and it was kind of a resort area, and we had a good 3-4 days there at that place, and then we spent the rest of the time near Denver or in Denver.
Oh, nice.
So,
Okay.
and anyway, I it has real estate. At the time, the building was worth about $350,000. He was asking $750 for the company, and this is a smaller company, obviously. And it was really dependent on him only from the aspect of estimating.
Okay.
Beyond, he didn't do any of the work. His employees do everything else.
So he was the estimator, though. So he was the person that actually figured out the what it would cost, and then he'd figure out what he'd charge for it.
Correct, and he has it down to art, and he's willing to train somebody that have replace him as the estimating, or he can do an estimation in just a couple hours, and and he's done. So he's really good at it. He's been 35 years, so that's a specialty. But and his wife answers the phones. So about 3-4 months after we looked at it, he had a horrible accident. Actually, he and several other employees were up on a platform where a heating system was installed inside of a residential property, which is, he does primarily residential.
Okay.
And he does do a little bit of commercial, but mostly residential. The platform was inadequately built, and it collapsed.
Oh my gosh.
And he was already having kidney issues before that. Well, pretty much that accident, he fell, I don't know, like a story down or whatever.
Wow.
Maybe even, I don't know. And the other employees didn't get hurt. Maybe they get minor bruises or whatever, but he landed on his knees and fractured several bones, and
oh my gosh.
Put him into dialysis a lot sooner than he thought he was going to be in dialysis. So since he's been in the dialysis chair, unable to basically get around, the revenue's gone up.
It's gone up?
It's gone up.
Oh my gosh, wow. Why?
And, I think because he can't go out there and do the physical work himself, so he's forced to sit there and dictate. He said his employees really stepped up. The whole town loves him. The whole the city, they just love him. I think they did a little benefit drive for him for medical expenses. I think they were pretty high. So, but
have you looked at current financials, or because obviously when there's something in the deal vault, and you said you looked at it about a year ago, are there current financials?
Okay, this deal actually was not the one in the deal vault. Sorry.
Okay. Okay.
So maybe I should put it in the deal vault and say that I'm evaluating. I don't know if I'm supposed to be doing that or not. I don't know. But
but in terms of now, is this one that you'd want to work on yourself, or would you be looking for assistance, or I mean, it sounds like you have experience with other businesses. Is this something that you'd be looking to bring on additional partners to help you with this deal, or what do you?
Probably the one in the deal vault would probably be more lucrative for somebody to bring in.
The one thing about the deal vault I want to make clear is if somebody else puts something in the deal vault, you have to understand that they're expecting a percentage of the, and I forget what I think what is it, like a certain percentage up to $10,000 or something like that when the deal closes.
Max, or I can't remember. Right.
I think the max, the maximum is 10,000, and I forget what the percentage is. Yeah.
Okay.
So that is something that if you didn't put in the deal vault, you'll have to consider that person when you're actually structuring the deal.
Okay. So basically, involve them in structuring it, or not?
Well, no, you just have to make sure they're going to get their payout when it's all closed.
Okay.
Right. So that means when you sell it and make your money, they get part of the profit, right? Because that's how this is structured.
Okay.
Right.
Yep.
The other thing too is, have you used the valuation tool to even with both of those? You put the financial information in to see if the price is reasonable?
I have not, and I just saw you put that. I hope you don't mind. I just screenshotted that website address.
That's why it's here. I mean, that tool is there for you, and I recommend that people, even when they start doing the initial portion of their due diligence, I say do that as step one. You know, if you most of these listings, and I don't know if they're current, but I mean, you'd have enough information regarding financials to at least give, because you know how it is. It's like people are pulling numbers out of the sky. You know, they're like, okay, I want to retire, I want $1 million, and it's like they just pull numbers out of a hat. You know, and a lot of times when like somebody comes out to actually value the company, they're always shocked at how much lower it is, you know, depending upon what they're doing. I mean, many of these business owners don't have processes in place. Many times the businesses are dependent on them to run the, you know what I'm saying? So it's like that lowers the value. So, you know, you want to make sure that they have, I mean, if they're going to ask like a $750,000 price, what does that mean? What is included in that? What does their customer base look like? You know, what's the profit margin? You know, you want to make sure that it's sustainable and it's actually worth that. And a lot of times people definitely inflate because they're looking at, okay, I want this. Well, probably for the guy with the dialysis, he's probably looking to retire and pay some medical bills.
Yeah, and I think he probably, because he keeps calling me, that means he's not advertising it.
Right.
He wants to sell it. He wants to keep his employees going.
Right.
And I think he probably would entertain some kind of owner financing. And
I'm sure he would, yeah.
So I'm just trying to figure out how to structure that one, I guess.
Well, step one, Jim, is to do that valuation. Do that first.
Okay.
Get that. Make sure you got current financial information. Make sure that you have, you know, because you want to see if there's a trend. Now, that's an unusual trend that the owner ends up getting hurt and the revenue goes up. But you want to make sure that everything else, the costs are still down and that, you know, his profits, his margins are still good. So just because revenue went up doesn't mean that that's a good thing, right?
Right. There could be other.
Right. So that would be my recommendation on the businesses that you're interested in. Step one, get the financial information as current as you can get it, and then put it into that valuation tool and see if the price that they're asking is even in the ballpark.
Okay.
Because I don't know if you were on there when I was talking about it, but, you know, I had somebody that I was coaching, and they had somebody that was being real arrogant, you know, kind of calling the shots and, you know, wasn't going to do anything, wasn't willing to bend, wasn't willing to negotiate. And then I showed him this valuation tool, and he punched in the numbers, and it turned out he had gone to a CPA to evaluate the financials, and the CPA pointed out a couple of things that were, you know, red flags. Like, for example, there was nothing in the financials that showed how the owner was actually getting money, right? Well, it turned out he was taking draws that were nowhere to be found in the books, so they added that in. And then the other thing that they didn't account for was the wife was doing the bookkeeping. So they put in what the average cost of a bookkeeper would be to replace the wife, and then all of a sudden the value of the company was zero. So when the value and this person was still interested in the business, I actually said walk away, and he's like, no, I like it, I want to do it. Well, all of a sudden it was like he was in a position of strength, and all of a sudden, guess what? That owner was, you know, negotiating. He was willing to do owner financing. He was willing to stay. He was willing to, you know, take a salary for a certain number of years. I mean, it was like amazing, all the stuff that this guy was willing to talk about, you know?
Okay. Well, yeah, that definitely sounds like a must then.
Yeah, and I mean, that's a great starting point. That's what I'm encouraging people to do. And that should be like number one in your due diligence, right? Because if they're asking an astronomical amount of money, right? I mean, you got to go back to them and say, look, I like your business, but, right? I'd like to pursue, but, you know, here I've gone to this value. And it was interesting because this person actually went to that owner, and the owner's like, let me have access. This is accessible to anybody, that valuation tool. So that owner was trying to fudge the numbers, right? And it didn't matter how they sliced and diced it. It still had no value. Right?
Oh, that's fun.
Yeah, so it was. So that would be my recommendation is for those businesses that you're interested in, definitely, and you may not have current information, but you probably have enough to at least get a sense, and at least you'd have enough information to at least start a conversation.
Right. Yeah, and at least get the conversation going on price and terms and that kind of thing.
Right, exactly.
Yeah, I think you're right, and I can make it contingent at least for that business, I can make it contingent upon, training somebody to replace them.
Absolutely. I mean, the sky's the limit. I mean, there's all kinds of opportunities. And what's interesting is it's not like 30, 40 years ago. Business was up for sale. You went to the bank, you got the loan, boom. That's not how this works anymore. I mean, business owners, especially because there's such an influx of business owners selling their businesses because of the boomers wanting to retire, and then there's nobody to give it to. It's everybody, and even with that financial crash that occurred, people are a lot more flexible than they were, right? I mean, they're open to being creative and, future revenues. I mean, if there's a business that's doing okay with profitability, if you've got a plan to increase profitability, I mean, you could offer them, 1%. Maybe today, that 1% wouldn't equate to very much, but maybe in 6 months, you've got a plan that 1% would be something big. You know what I mean?
1% of what, the price?
Whatever. You have to. No, I'm talking about like future revenue. A percentage of future revenue.
Okay.
And you could actually set milestones and metrics, and then it's like if you hit a certain level, you get X. If you don't get it. I mean, there's all kinds of ways to structure these things.
Well, I feel absolutely blessed that I'm the only one on the call today, because I was the only one at the share sale this morning also.
Well, here's the thing, and I don't know if you were on the call 2 weeks ago when I did it. I mean, I try to open they've been telling me just do, and that's why it says coaching call. They're like, just let them talk. It's like, then when I try to do that, nobody talks. Right? So then I put content together. Then now everybody said they wanted this as the content, so now I do it, and nobody shows up, right? But I'm constantly these webinars are so much better when we got people talking and asking questions and telling stories.
Well, and I think I was the one that requested this content, and I'm here.
Yeah, you're right. Okay, so good. Thank you. Well, we'll continue this, but I got a lot more stuff here. But it's a list. I mean, I'm basically talking about a list of stuff, right?
Right. And one of the reasons I guess I brought that up was it last week? Yeah.
2 weeks ago, yeah.
2 weeks ago, okay. One of the reasons was because, and this is something maybe I guess I'd like to kind of maybe pick your brain on this, but when you're trying to decide which businesses you're going to look at and which businesses you're going to spend your time and focus on, it's just, to me, there's a correlation there with real estate. Are you gonna spend your time looking at this house and dealing with this house that doesn't have any money in it, or are you gonna focus on another one that's more profitable and this and that? And so maybe I can draw parallels from real estate looking at businesses, but when I'm looking at these businesses, I guess I just want to kind of I had a really good call with Patrick the other day, or maybe it was 2 weeks ago, and he said, Jim, always have 3 businesses that you're evaluating.
Right. And always have a vision and a plan of what you would do with it. Start noticing things. Eyes wide open. Pay attention to what's going on. A lot of these businesses, they're so in it and they're so tired of it, they don't do what's necessary. So things that would be obvious to you and me. I was actually talking to somebody what he does is he works with franchisees. And basically what he does is he listens to the way they talk to their customers, and then he helps them to have the conversation in a way that they would bring in more revenue. So, for example, he gave me the example of elder care, right? And he says, was looking for elder care, so somebody calls, and so instead of the franchisee person saying, okay, we'll set up this service and we'll start on such and such a day, it costs X. He'd be like, well, does your loved one ever miss their medication, right? Do they ever need to be taken to the doctors? Those are all additional services, right? So just by asking those questions, and I think I've shared that Starbucks in the airports, I mean, one of their strategies, bottles of water cost more than their coffee, some of their coffees. And basically, so if it's a Starbucks that's past security, like inside security, they taught their employees to say, would you like a water with that coffee? Well, now, okay, they sold a cup of coffee and they sold the bottle of water, which increased their revenue significantly.
Actually, when you brought that up in that call, it actually triggered things in my own businesses that I have, even our bail bond business, additional streams of revenue, and I don't. This just came out yesterday. There here's another motive for me is, I don't know how long bail bonds is going to be in existence because it's constantly under attack. But that's my primary revenue source right now. But yesterday, it just, I don't know if it just came out yesterday, but that Google and Facebook are no longer going to allow advertising for bail bond companies.
Interesting.
And because I guess they just decided that they want to dictate what businesses survive,
Interesting. Well, there's other options for you. I don't think that's a barrier for you, so. You know what, Jim? I got to end it because it's 5 after. So I appreciate this discussion. I'll continue. I won't be doing it next week, but I'll do it the week after. So we can continue these conversations. I'll continue going through the checklist. And if we have a small group again, let's continue the conversation.
Okay. Yeah, the checklist was really for me to try and figure out what to focus on and streamline my process of evaluating.
Was it helping?
Yeah, absolutely. It's going to help.
Okay,
sure.
Good. All right, good. All right, well, I'll be on this call in 2 weeks.
All right. Well, thank you very much. Have a great night.
Okay, thank you. Bye-bye.
All right. Bye.